All right, well, first, my name is Chad Hutchin. I am a graduate student here in the BSNPA program. I will be graduating this spring. I'm doing this presentation on how secrecy culture affects financial disclosure for Dr. Madeline's Trimble International Accounting class. I would like to thank you all for coming, and hopefully you'll learn something from this, and it'll be something that'll keep you entertained, and we'll try to get it done within about 30 minutes or so. Okay, first, what are financial disclosures? For the accounting majors in here, it seems pretty simple. For those of you that aren't accounting majors, when we're talking about financial disclosures, we're going to look at the existence of audited financial statements from different countries. And that's talking about whether they produce an income statement, a balance sheet, a statement of retained earnings, their statement of cash flows. And then one of the bigger things you're going to see as we move along is whether they consolidate or not. And consolidation is the process of when a business has subsidiaries that they take those that they own, and then they put all of that information together into one set of financial statements to present to the public. Now, within those statements, there's many different principles that can be used. And what we're going to be concerned ourselves with today is the recognition of the disclosure principle, financial disclosures, how much they're willing to say when they give out their statements, and then the measurement principles, what they do to the information when they put it out, how accurate that information may be. You may wonder why this is important for an international business group, right? Because it seems like a lot of accounting talk. And I noticed when a lot of people signed in, there weren't a lot of accounting majors. But accounting is the language of business. And that's attributed to a lot of people, but most commonly Warren Buffett gets that name. So when you think of different languages around the world, you're thinking business is pretty much the same, right? So if I'm doing business here in Japan, of course the language is different. I just change it to English, I change the yen to dollars. Everything's good, right? You would think that. But think about your friends for a minute. Everybody speaks the same language, right? I'm sure you all know one of these. You all have a blabbermouth friend. Someone that just wants to run their mouth all the time. You know everything about them. You know the good, the bad. You know what they had for breakfast. You know when they went to bed. More than you need to know. And then you might have the confident friends. The ones that are willing to tell you anything and everything, but within reason, you know. They don't need to give you every little detail of what they got going on. They're just going to tell you the major important things. They don't hold back the good stuff or the bad stuff. They just let you know what's going on. And then you have some quiet ones. The ones that you really got to probe and prod into. The ones who your friends you know, you say, hey, what's going on? I don't want to talk about it. No, come on, tell me. And you'll finally get the information out of them. Maybe. Maybe you won't. This is actually one of the biggest range of your friends probably, because there could be so many different scenarios with the quiet ones and what they want to tell you and what they don't. And then finally, I'm sure a lot of you have the embellisher too. The one that wants to tell you everything, but you know you can't believe a darn word that comes out of their mouth. Well, the thing is, businesses are the same way. We talk about around the world in the way they prepare their financial statements. You're going to have some quiet ones, you're going to have some confident ones. In business, you really don't have many blabbermouths, and occasionally you will get the embellisher. So, with that being said, there's been a lot of accounting research done starting back in the late 60s and trying to classify accounting languages, as I just kind of classified how we would put our friends into 4 different sections. But the first major study that came up with a general classification has been accepted was done by Christopher Nodes in 1983. He expanded some prior flawed methodology that was done in the research because he looked at 9 attributes from 16 countries, but they were all audited by PwC in 1983, and they came from westernized nations. The prior studies had used these same companies, but they had only gone by questionnaires. So they got a lot of answers on what people were supposed to do and not what they were actually doing. So Nodes took and he actually examined the financial statements to find out what they were actually presenting compared to what they were supposed to be doing. And when he tested some of those attributes, 3 of those were based on who the users were, and the other 6 were based on measurement principles, such as historical cost, replacement cost for inventory, fair value adjustments, and different things that could matter in disclosure of what investors would want to do. From that testing, he developed 2 major classes of accounting system, the micro-based class and the macro-based class. The micro-based class are based on business needs. Those systems is like what we have here in the United States. It's very open. We like to disclose a lot of stuff. It's also very popular in the UK, and then IFRS is a micro-based system. We're going to focus on today is what he's identified as the macro-based system. Those are accounting practices that are based on legal and tax needs. Those come from countries that have code law where they specifically design the accounting practice are uniform. They tell you what you have to do, what you have to report, and you're going to pay your taxes based off what it says in your financial statements. If you're not aware, in the United States, that is not done. In the micro countries, you usually get to keep 2 sets of books. You get one for your financials that you present to your investors, and another one you present to the taxing authorities that you pay your taxes on. So within those micro and macro classes, those also develop some subclasses, families, and species, which he just kind of took off the Darwin's chart to use those names. And this is what his final chart ended up looking like from the 16 countries that he identified. So if you notice the micro-based ones up here, they breaks down. You have the US, the UK, and the Netherlands. They just get a special spot all to themselves because they're just kind of unique. And then over here in the macro classes, you have more, they break it down into the tax part, government, and then tax and law. And it was just very generic descriptions at this point. Because what he did is he took those 9 attributes and he did it on a scale of 1 to 4. And he said, you know, if you're good, you get a 4, bad, you get a 1. And there was a very distinct between the micro and the macro, but when you got into these bottom ones, it was just all kind of jumbled and you really couldn't tell. So then in 1987, Ian Berry went out and said, we need to expand this a little bit. So he took those research and he used the exact same methodology that he did. He looked at the presentation and he sent out questionnaires, but he expanded the amount of businesses within the same countries. And he also added 37 more capitalist countries, and he added 11 communist countries to his mix at this time. And what he found was similar results. The micro and macro-based companies that were included in both studies, they didn't change at all. And he just developed it, and he put some more on this side and some more on this side. And he discovered when he did it that he had to add a new family class for Latin America because of the inflation adjusted accounting that has to be done there is so different than anywhere else in the world. And this is what his map of micro and macro-based countries ended up looking like. You can see the micro down here at the bottom still comes out. The Netherlands still sit down there all by themselves. And then you have the US and the UK, the law, tax base ones up here. And then the communist countries form their own little setup here. And we're going to get into more of that a little bit later. But it's a unique set of accounting rules that communist countries do compared to the rest of the world. And then finally, to what we get to the major accepted classifications, to show you how detailed it can get, Timothy Dubnik and Stephen Salter did an empirical study of both Noakes and Berry's research. So what they did is they sent out an even bigger questionnaire to more people and examined more. They sent it out to a total of 75 countries. They got total of, I can't see my notes, but they got 500 and some responses back from this thing, and they threw out any responses that didn't match with the other responses from that country. So if they had any outliers, they just kind of disregarded them. And if they had any countries where they only got a singular response, they just disregarded that country as well. And it left them with a total of 50 countries that they were able to identify. And because of some of the issues we'll talk about with the communist countries, they did exclude them as well. And once again, they verified the original Noakes results for the micro and the macro countries. We didn't see any change in them. But what they did by doing the statistical analysis, it was able to break it down and develop many more subclasses and actually give a better direct relationship on how different accounting languages are recognized to each other. So this is their chart. As you see, they don't give their classes any names, but every little number, every little bar has a number going down from it, okay? So start with the smallest number means the biggest difference. So up here at 1, the biggest difference is between the micro and the macro countries. If I'm down here, the smallest difference is number 49 between the United Kingdom and Ireland. But what is really, really interesting about this chart is look, when you get over to the micro, we're at number 8 already. So there is still 7 more things that are different between all of these countries and the macro side compared to what these are. The second biggest difference is between this group of countries, these 3 over here, Germany, Japan, Germany, Finland, and Sweden, and then the rest of these within the macro base, as you can see, the 2 falls out, and then the 3 and the 4. So actually, Japan and Germany, even though on the same side, are very, very different in the way they classify their accounting languages. So even though we're getting these classifications and we're putting them in the families, it's very difficult to tell what's going to be in each financial statement based on just the family or the class they're in, as you can see from this empirical analysis. So, but we can make some generalizations from this. The generalizations we can make is micro-based accounting systems compared to the US-based type of systems. The primary users are the government taxing authorities instead of investors, and stuff like that. They usually have a uniform set of accounting rules which are designed, set, and specific. Now I know if you're studying accounting in the United States, you're like, oh my God, I took accounting classes. There are so many rules. How can the United States not have rules? The United States does have rules, but they're more principle-based and they guide you. And they say this is what you should do, and they have industry-specific. When I talk about uniformity of the rules, it's you're going to recognize revenue this way. It doesn't matter if you're a manufacturer or retailer or whatever. That is a more uniform set of rules in like macro countries. They are less likely to have consolidated financial statements based on tax provisions. Generous use of provisions, or what we might call here contingent liabilities. Macro-based countries usually are very generous with allowing their management to smooth out their earnings to not allow them to fluctuate over time. So they do that a lot through contingent liabilities. And then their measurement and recognition principles. Less accruals for expenses. This is stuff like pension expense, where in the United States you accrue it as it happens, as it goes on. They're just expensing it as it's paid, so you don't know the full extent of the liabilities there. A lot more historical cost than using fair value, and there is less consideration for replacement cost of inventory. And that's all good to know, right? But why? Why is this happening? If business is the same all over the world, and everybody does sales, everybody has cost of goods sold, why can't we all just get together and just talk in the same language, right? Well, in 1998, Sidney Gray proposed that the methodological framework incorporating culture may be used to explain and predict international differences in accounting systems and patterns of accounting development internationally. So basically he's saying culture could have a major impact on how the accounting systems are formed and developed. And here's the basis of his theories. We have some external influences, ecological influences, which lead to societal values, which we're going to talk about in a minute. Those societal values then lead to certain accounting values, and then when you include the accounting values and the societal values, you come up with an accounting system. So that is his general theory. It makes sense, but to explore that theory, we first have to understand what culture is. Well, the modern definition of culture comes from Gerd Hofstede, 1984, the collective programming of the mind, which distinguishes the members of one group of category of people from another. So if you think back to my original example where you have all the friends, you have the blabbermouth, the lion, and stuff like that, you could say that is a set of culture maybe derived from your family. And as that gets bigger, bigger and bigger, that just becomes the culture of the group. Hofstede then went on in 1984 to give us some dimensions that we can measure culture by, an idea to get. Now this is a very long and interesting subject, and I could spend hours just talking about that, but for the sake of time, we're going to try to run through these very quickly. These are the first four he introduced in 1984. The last two were added in 1991. As we go on, I just want to mention we're only going to focus on the first four for the majority of the accounting studies because it's all that's been accepted and used. But I will touch on the last two on here real quick. So the first one is individualism or collectivism. This measures how society is tightly or loosely knit and whether you're looking out for the I or the we. So individualistic societies, I am number one. I want to do what's best for me, and I don't care if it gets in my way. In collective societies, we want to make sure that the whole society is the whole taken care of. I'm making the stuff for me in order to benefit society. When you look at the score ratings that come from HofstedeInsights.com, the United States ranks highest in the world for individualism at 91, and Guatemala is the lowest at 6. I will mention that the scores go from 0 to 120. Power distance is our second example here. Power distance is the degree to which people accept inequality in society. And this is kind of, when I first started reading about this, it's a unique thing and hard to wrap my head around because the United States is ranked at a 40. And I don't think living here that we accept inequality all that well, in my personal opinion. We're always trying to make things change. But that's the exact meaning of this dimension. Because the United States is so low, even though there's inequality is everywhere. We can't do anything about it per se, but in the United States, there is more of a chance to change where you are and advance your rank. So that's why we are less accepting of inequality than other countries. And that might be a better way to think about it. High power distance is someone like Malaysia, and actually China is up there really high too. And those countries have really strict, rigid class structures where if you're born in the lower class, you're going to stay in the lower class. If you're born in the ruling class, you're going to be in the ruling class. And one of the lowest ones is Austria coming into the other, which allows for great mobility in classes. Our third dimension is uncertainty avoidance. This is the degree to which society is uncomfortable with not knowing what is going to happen. Okay? If you have high uncertainty avoidance, you're going to want to make plans. You always want to have rigid rules. You're going to be prepared for every little thing that's going to come your way. Greece is a good example of that at 112. And if you know anything about Greece recently, they've been having some financial troubles and financial crisis. So it kind of makes sense that they are kind of that way. If you have low uncertainty avoidance, you have more of a relaxed attitude. Just, hey, let it come as it comes. Just kind of kick back and let things go. Singapore is the lowest on that at 8. In the United States chimes in kind of right in the middle again with a nice 46. The fourth quality or dimension is masculinity, femininity. Now this measures how society values achievement, or is it material things you're going for? Are you praised for being heroic? These are traditional masculine qualities, so that would fall into the masculine. Or on the other hand, is what you're doing for society. Are you more modest? Are you more caring? Are you putting all your efforts into making the world a better place? Those are considered more feminine qualities for the purpose of cultural studies. So you see Japan ranks highest on the masculinity scale. And it's actually one of the countries I'm going to talk about, so I won't get into it, but they are very, very masculine in Japan, and you really want to be high achievement to succeed in that culture. And on the low end, you have Sweden. Sweden ranks a 5. They're almost level to a 0. So they are very, very daring people, and your achievements are not going to impress them much when you go there. The United States is fairly high on this one. At a 62, we do value achievement too, but as you can see, not being up in the 80s, 90s range, we still have a lot of carry. Now these last two were added, as I said, were added in 1991. Haven't gone into a lot of the accounting studies, but they are very important when you're looking into culture. The first one is long-term versus short-term orientation, and that's how society is just kind of planning on doing it. Are they worried about what's going to happen in the next few years, or is their society making plans for what's going to happen in the future? If you're going to plan for the future, in the business terms, it's called being pragmatic. That means you're going to encourage, we always want to be on the cutting edge of technology. We're always looking for new ways to do things. We always want to jump into the next century, the next decade, being the people that lead the way. If you're normative, you just want to maintain some time-honored traditions. You're short-term, you want to do things the way they've always been done. You're afraid of change. In a country like Nigeria, ranks really low on the scale there. And I was actually kind of surprised to see that the United States ranks kind of low, that we're more focused on today than we all are in the long term. And finally is indulgence and restraint. And that's just basically, it's a measurement of how well we're going to satisfy our physical needs. Do you want to indulge in everything you want to do? You're going to go out no matter what the law says and just make myself happy, or are you able to show some restraint? Venezuela ranks highest in that at 100, and Egypt the lowest at 4, with the United States coming in at 68 again in the middle. All right, so what we need to do is we need to take all those things that we ran through really quick there and try to throw them into some accounting value theory, okay? So that's what Gray did. So he took a look at each of those and he came up with 4 what he considered accounting values. The first is professionalism versus statutory control. What he's measuring there is, are you using professional judgment or are you obeying the law? How is the accounting system based on? What are they giving more preference to? The second one is kind of the same, uniformity versus flexibility is how the laws are written. Are they more uniform and strict for everybody, or do they allow some flexibility for different industries or what's up? The third is conservatism versus optimism, and that's kind of goes into the secrecy and transparency that we'll talk about last, but it's more based on the measurement principles there. Are we using conservative measurement, or are we being optimistic? And the one we're going to focus on is this last value, secrecy versus transparency. So we're going to take the 4 major things from Hofstad's and we're going to relate them into secrecy versus transparency, and particularly how it relates to secrecy culture. And secrecy culture in general is just a lack of wanting to show information on your financial statements, a lack of wanting to disclose how you got your measurements, or if you're disclosing any information at all. So, individualism. Individualistic societies, as we said before, are looking out for the I. They're looking out for the we. And the opposite of that is being collective. When we're being collective, we're looking out for the groups. So when we're looking out for, we have high individualism, right? We are going to have low secrecy. We have an inverse relationship there. Because if we're looking out for the I, we are going to want to show everybody what we're doing. We're going to want to prove to everybody that we are the best, and the only way to do that is to by disclosing as much information as possible. Whether it makes us look good, or if we want to beat the competitors, we want to know all their information so we can make them look bad. Okay? But on the other hand, if we're a collectivist society, we don't have a need to know. We know that as a society, we're all looking out for each other. So there is no reason for you to disclose information to me because I believe that you are looking out for my best interest. Therefore, I don't need to know, and disclosure is less. Power distance. Power distance, if you remember, is how the classes rank themselves in your ability to move through it and how accepting people are of that. Power distance has a direct relationship with secrecy. So if you have a higher power distance, it means that the people in the lower bottom class, they're not going to challenge the people at the top class because they have no chance to take their position in life. And if those people at the top wanted to just squash them, they could. So the people at the top have no reason to disclose information. There is no reason for anybody to know what's going on other than the people that are within their own general class. On the other hand, if the power distance is low and you have the ability to jump up, there is more need for information because you want to know how you can advance. You want to know how you can move up. And the only way to do that is to have the information available to you. In the fourth dimension, uncertainty avoidance. Uncertainty avoidance, again, is a direct relationship with secrecy. So if you have high uncertainty avoidance, it means you are uncomfortable with ambiguous situations. It means you fear the unknown, right? So having more information, that's just more stuff to make you worry about. If we're going to disclose all our contingent liabilities and all this stuff that might or may not happen, that is not going to sit well in a culture that wants to be guaranteed of what's going to happen in the future. But on the other hand, if you're okay with things being a little bit crazy and you're not worried, you're going to want to know all the information. You're going to want to know what the lawsuit's going on. You're going to want to know what the bad debt expense is and that kind of stuff, and you expect things to be more fluid. In the final dimension, masculinity has an inverse relationship with secrecy. So the more that the culture values achievement, the more people want to achieve. And once they achieve, they don't want to let you know how they did it because who knows how they got there. They may not have gotten there the right way. It just invites a culture of secrecy. Once you put such value on the end result, then once you get there, it's not really enabling in your best interest to look how that was done. On the other hand, if you're on the feminine side of this characteristic, you're more open and more caring, so you're more likely to be open with and transparent with your financial statements. So just in a recap here, in relation to secrecy, we have individualism being negatively related, power distance positive, uncertainty positive, and masculinity negative. So this was just a theory that was put out by Gray in 1988. It was never tested to be, at this time, it was just a hypothesis, a theory, and it has withstood the test of time, I should say. As we're going to see in the next slides, we're going to go through Japan, China, and Egypt real quick. And I'm going to show you their scores and kind of their accounting systems and stuff like that, and how they rate on these scales. So we're going to start in Japan. Japan's culture. Japan, on the individualism, collectivism scale, Japan is a unique culture in the fact that they would have what they say, learned collectivism. A quote from Duda in 2018, they create a corporate culture where there's unquestioned obedience and loyalty to the company. However, from my study, in their personal life, in society, they're not such a collective society. It's more of an individualistic society. So when you're born, maybe if you're the firstborn, you might be expected to take care of your family, your immediate family. But as you move on, if you're the secondborn or others, you're kind of on your own. And it's not so much as a group, not so much of being an in-group in society, but when it comes to business, it is very collective. So it gives it a unique score. Japan scores a 46 on the individualism scale, which is kind of low. And we remember individualism an inverse relationship to secrecy. So if they have low individualism, they're going to be a little bit more secretive. The power distance in Japan, there's a clear hierarchy in Japan, especially in the business world. People know who their superiors are, and they make sure that the business decisions run with their superiors. They go, and there is no way to jump those ranks. And if you try to go outside of your ranks, it's highly frowned upon. And there's also the concept of saving face, which is very popular in Japan and other Asian cultures, where they do not want to be embarrassed, and they definitely do not want to be embarrassed by someone that is subordinate to them. So you would think that they would have a high power distance, and they're kind of in the middle of the road. And again, it goes back because even though their business may be structured that way, when it comes to the personal lives, there is a little bit more flexibility in the social structure. Uncertainty avoidance, I'm going to give you their score first, because this is one they rank very, very high. Japan is very, very high in uncertainty avoidance. They do not like, they have a big fear of the unknown. A lot of that is their positioning in the world. Of course, World War II was a bad time for them, there were a lot of changes. And then being on the coast, they're always susceptible to major storms, tsunamis, earthquakes, stuff like that, so they weren't prepared for that. And then they've had two major financial crises in the past 20 years, which has kept the financial sector on their toes. So Japan is always constantly planning and preparing for the next disaster that's going to hit them. And finally, masculinity. Again, it is a very, very high score. 95. It's almost one of the highest on the scale. And as I mentioned before, it is based on achievement in Japan. The value you get is based on what you can do and what you can achieve. But one of the important things is right there for men. Masculinity, femininity dimension doesn't necessarily measure this, but when it comes to Japanese culture, it is still a very male-dominated society where men can rise in the ranks much faster than women. So our uncertainty avoidance is positive, masculinity negative. It looks like we should have a very secretive culture in Japan. Would you all agree? Well, I would agree, and their accounting system seems to show that. Japan has their own accounting language, Japanese GAAP. They've attempted to merge with IFRS, but they've not fully done so yet. So the Japanese standards are set by the Business Accounting Deliberation Council, the BADC. It's a government council, and for years and years and years, they have a limited set of rules, and they did this, and it was basically just for taxing purposes. Okay? The Accounting Standards Board of Japan was started in the early 2000s to kind of get a private organization body, kind of like the FASB in the United States, And in 2014, they kind of converged the two and said that you have to follow both standards. Okay, we want to back up a little bit because that's where they are now. But before that, they were very secretive, as I said. They had very little laws, very little rules on what you had to do. And because of that, they had some scandals that arose and some needs for changes. And DADC made major accounting rule changes in 1997 and 1998. As you can see, they made more accounting rule changes than in the previous 10 years combined. In those 10 years. And it was because of the way people were accounting for things. The big thing, one of the big things with this was this fair value adjustment for securities. So prior to 1997, there was no rules on how people put securities, which are investments in other companies, onto their balance sheets in Japan. So a company named Olympus was going through some rough times as the economy started to turn in Japan, and the export market went down. So what they did is they decided to invest in speculative securities. And they took a beating. They lost a lot of money on these speculative securities. But with no principles in place and no rules and very secretive, they kept listing these securities on their balance sheet year after year after year at the historical cost of them instead of making a fair value adjustment. The company went through multiple CEOs before this was finally discovered because everybody wanted to save face. Nobody wanted to be the one to bring this to light. And then I believe it was about 5 years after they started doing this, they ended up losing over $10 billion that they finally ended up disclosing on the loss on these securities. And that was what led to the Japanese government looking at these accounting rules and coming up with a lot of these changes, such as fair value adjustments for securities was the first one that they put out. We're requiring this to happen now. Before that, research and development costs. In 1997, they required you to start expensing. Before that, that was something you could always put on your balance sheet, which would make your income statement look better. Expanded consolidation requirements. Before 1997, it was very rare to see consolidated statements in Japan because of the lax requirements on what was required for you to put them together. And the pension expenses, as I mentioned before, with the accruals, there was no accruing of pension expenses in Japan prior to 1997, so there was all these benefits that were due to people that were retiring, and these companies were coming up and having to pay the benefits, and they had no liability, no plan for it, because they hadn't been recording it, and all of a sudden they're getting hit with big pension expenses, and it's just kind of throwing everything out of whack. So even with those changes, there are still some major secrecy concerns that are going on in Japan's accounting system right now. And one of the major ones is the revenue recognition standards. Up until 2018, when the ASBJ put out the standards, which I will mention there in Japanese only. I tried to read them so I could tell you what they're all about, and I couldn't access them because I can't read Japanese. So even that's kind of secret of not being able to read them. But before that, their revenue recognition principle was, quote, industry standards. Now that could be a lot of different things, because if anybody studied U.S. accounting, you know that revenue recognition, we just got a new principle on it. It's a 5-step process. It's very detailed. And when you can recognize revenue is one of the most important things to your business, because your top line affects your bottom line. One of the reasons I brought this about was a Toshiba fraud case that started, I believe, in 2014. So Toshiba, when people think of them, when I think of them at least, I think of electronics. But they were also in the business of building nuclear power plants. In 2014, they started many contracts where they were using the percent of completion method in order to recognize revenue. For those of you that aren't accountants, that means you may sign a contract for $10 million that they're going to pay you when the contract's over, but it might be a 4-year contract. Well, the percentage of completion method allows you to recognize a portion of that revenue each period based on how much you've gotten done off your costs. But in order for that to be accurate, you have to estimate your costs accurately. And anytime you have cost overruns, you need to put that in and show losses in that period. And there's very strict guidance when it comes to US GAAP on how you will make these entries and how you will make these adjustments. But with the lack of principles, Toshiba was able to run a multi-million-dollar fraud where, again, it took 4 to 5 years. It wasn't started in 2014. It wasn't 3 years. It wasn't until 2017 that they started to actually report these losses for these contracts. Some of these contracts they signed, they even took a loss as they signed them, knowing that their expenses were going to be more than the contract was worth, because it was a strategic need for them, because the contracts came from the Japanese government. And they knew without any recognition principles in place that they were going to be able to manipulate their books and get away with providing the correct information, which is exactly what they did. Some other secrecy concerns that come from Japan is their use of provisions or contingent liabilities. As I said before, secrecy cultures gives you the option to kind of smooth out your earnings by doing this. The standards in Japan say it has to be highly probable in order for you to create one. And again, that is an interpretation of someone else who's trying to interpret Japanese, because the Japanese standard is very ambiguous in its own. Up until 2002, there were no impairment rules. Impairment is when you can write down the value of an asset because it has lost value. Well, that was not allowed up until 2002, and even the new rules they put into place are still very, very strict about allowing you to write down values of assets. So it would be overstated. A lot of historical costs still in use instead of fair value adjustments. They made it with securities, but the long-term assets still no disclosure requirements. Auditor independence is a big deal in Japan too. When it comes to masculinity, the ability to save face, getting people to audit your financial statements is an issue because you're just getting rubber stamped. They're just telling you what you want to hear because they don't want to embarrass you and they want to save the reputation of their audit company and your firm. And I read of a case once where even the independence comes into question, where a CEO of a car manufacturer left being CEO, went on to be the chair of their audit committee for 3 years, went back to being CEO for 2 more years, then went back to being the chair of the audit committee. And that is not uncommon in the culture for people to switch positions within the same ranks where they shouldn't be for independence concerns. And finally, old habits. The changes weren't made until 1997. 2014 was when they started to get their own private sector, merging with IFRS standards. There's still a lot of things that people are not going to want to do, they're not going to be trying to do, and they're just not going to be ready for it. All right. So let's move on and talk a little bit about China. China is one of those communist countries that was listed before. So, is anybody familiar with what communism actually is? So communism is when the states own all the means of production and everybody is paid equally and fairly based on their contributions to society. In Chinese communism, it's called Maoism. And the major difference between Maoism and just the traditional Marxist communism is Maoism believes that the revolution must be led by the peasants. So there is more of a hierarchical system in a Maoist communist society that needs to be overthrown from the bottom. So as it relates to individualism, communism creates a very collectivist society. Everybody's trying to look out for everybody else. You don't want to stand out above yourself or above anyone else. You just want to, so it makes sense that their individualism score is very, very, very low. Okay? But when everybody's looking out for themselves, this is where the contradiction comes in, because their power distance is at 80. The power distance is very, very high. So you think in a society where everybody's kind of looking out for each other and stuff like that, maybe there wouldn't be such clear lines. And communism is a struggle to make everyone kind of equal, right? And it greatly contradicts with another Chinese philosophy, which is Confucianism. So Confucianism is a very rigid, straight set of rules which says, you know, children obey your parents. You know, subordinates obey your bosses. Everybody falls into place, everybody stays in line, and everybody stays in their class. As Chow put it in his research in 1995, members of society should know their own positions with a whole societal setup and behave in a manner consistent with the expected code of conduct. I just read a recent article too about some of the new cultural changes that are going on in China now. So now so if you're breaking some of their laws, are at the point now where they're taking away basic society function from you. For example, if you're caught doing something, maybe you don't get to ride the bus, you get kicked off the city bus, you lose your bus pass, stuff like that. So they're very strict on their laws and their rules, and they want you to know your place, and you need to stay in there. On the scale of uncertainty avoidance, China ranks very low on that, but it is kind of a contradiction because when you talk about Chinese society, they're very low on uncertainty because there are many, many, many different cultures within China. You can travel 60 miles, and even though you may say you're speaking Mandarin Chinese, you run into a different dialect where you hear the same words with different meanings. That has led people to be very adaptable, per se. So they're able to, their uncertainty avoidance is very low because they're okay with ambiguous situations. They're okay with going in the unknown because just traveling around the country does that. However, in the business world, the communist set of principles, the uncertainty avoidance is very, very high. Because when it comes to the accounting standards, you're going to see everything is about resource allocation. It's all about planning and what we're going to do here to cover this and how we're going to get all the resources that we have available to the people in the most efficient way is what their thinking is. But nonetheless, it does score rather low on the scale. And finally, on the masculinity scale, they're rather high in masculinity, especially when it comes to business. Again, in the social life, maybe not so much, which pulls their score down, but in the business world, it is not uncommon for Chinese families or Chinese men to leave their families to go out to find work as a farmer, or for students to leave their families to go overseas, wherever they're not, just for that sense of achievement, sense of success, and a chance to build themselves up rather than staying back and caring for their family. So, the accounting system. As I mentioned before, from 1940 to 2007, China used a communist accounting policy, which means they use fund-based accounting. Now, if we have any accounting majors in here, might have had the joy of going through Dr. Patton's Accounting for Government and non-for-profit institutions, where you learn all about fund-based accounting. But it is nothing like what we're used to seeing in normal accounting. Because in these types of situations, it is more about resource allocation. So you're getting money from the government in the forms of grants or something like that. And that money may be earmarked or may be designed where it has to go for this specific purpose. Or bank loans may give you this money, but you have to use it for this. And that's what fund accounting does. Fund accounting is a way to not track profits and losses so much, but to track the money you got coming in and to give an account of where it went out. As globalization and the world global business started growing, the Ministry of Finance decided that they needed to start making some changes to get China more competitive in the global market. So in the early 90s, they started allowing companies that had shareholders that were located outside of China, they started allowing them to present financial statements in their own accounting language, whether it be IFRS or US GAAP and stuff like that. And then in 2007, they finally took the chance and they ended communist fund accounting entirely throughout the whole country and said it was no longer allowed. They issued 38 standards, which I don't know if anybody has looked through the US notification standards. There's 610. So their standards are not a lot there, but at least they are moving in the right direction. And then in 2012, they amended those standards, which supposedly brought them within 90% compliance or convergence with IFRS standards. So they are trying to change their culture to a more open setting where they're presenting more information. But some of the major differences still come in the asset valuation when it comes to securities and it comes to long-term assets. China is still on historical cost. They're not allowing for any of the fair valuation adjustments. And that typically relates back to the communistic society because there the government was setting the prices, so the historical cost, it didn't matter because they had complete control. And there are several special circumstances that happen around the world, such as pension expense, certain types of mergers and acquisitions that happen in places in the world that don't happen in China. And then there's certain mergers and acquisitions that happen in China that don't happen in the rest of the world. So they create some really unique and special accounting circumstances. So that's a major difference, which is really detailed and hard to dig into. And then finally, anytime IFRS comes out with the rules, China is delayed in implementing those rules themselves. It takes on an average about 4 to 5 years to review it and send it through other processes before they decide if they want to put it into their accounting or not. All right, so a lot of secrecy concerns with China coming out of the communist society. We'll give them some credit. They actually have one of the most transparent ways to find financial statements of any other companies anywhere in the world. The reason being is that every company is required to file a financial statement with the government for tax purposes every month. But you can access those files and you can see what you want to see. But just because you have the financial statements doesn't mean that, and the standards are there, does not mean that you're going to see everything you need to see. Accuracy. Statements may not be accurate because what I like to call justified mistakes. This is where people know the rules and they just don't want to follow them because of old habits. They're used to doing things under the communist way. They've done it that way for years and years and years. It's not a lack of enforcement, so they can get away with it. And second, a lack of training and experience. You imagine from 1940s, 1950s up until 2007, they had all been taught fund-based accounting. They had all been taught the communist system. And now all of a sudden all the rules changed. So all their accountants have to learn all new systems, all new terminology, all new language. There's bound to be mistakes happen, even just whenever, even with the best intentions. And finally, it's just a refusal to change. Some people just don't want to change, and they're not going to change. And lack of enforcement allows them to get away with it. The Chinese Securities and Regulations Commission does regulate public companies in China, and they do have some rules. And they have a lot of power when it comes to, say, Beijing or Shanghai, but you get out of the major cities, and then it comes more to the local authorities. The Ministry of Finance and this regulatory commission put out the rules, but it's the local cities and states that are required to enforce those laws. And it is not uncommon in China for bribes to happen. And a lot of people get away with nefarious acts because of that. And many people turn their heads in order to save face, and because of the strict power distance and the hierarchy in the people. And finally, auditing is another big issue in China. Especially with new standards, it's the auditors having the intelligence and the knowledge to go through and do the audit. And again, the not wanting to disappoint a superior or another company they face in the hierarchical scheme. All right. Finally, we're going to look at Egyptian culture. Egyptian culture is a little bit different because we've stayed in 2 Asian countries. Now we're going to move into the Middle East where it's a little more Arabic influence. And maybe a little more Islam. In this area, they have a very collective culture when it comes to collectivism. They're always trying to look out for each other. And when we look at China, it was very collective in your personal world, and they didn't care so much about the business world. When we looked at Japan, it was very collective in the business world and kind of individually social. Well, Egypt, it shows that it is very collective in both of those. It has a very low score on individualism, a very collective society. The power distance in Egypt dates back to Pharaoh. The history of Egypt is well known. Think back to the pyramids and stuff like that. You had the Pharaoh, and then you had his servants, and then you went on to kind of the working middle class, and then you had your farmers and your peasants, and then the slaves. Um, Throughout history, Egypt has changed powers and had rulers come and go. They've been under the rule of many different empires. But throughout all that time, that hierarchy has pretty much stayed. You still have your ruling class, you still have your working class, and your peasants and slaves. Uncertainty, so it gives them a very high powerlessness. Uncertainty avoidance is a very high score for Egypt. Egypt is a society that has gone through a lot of changes with all these different rulers and different, they've been ruled by the British was their last rulers when they became free from them in 1922 in their own country. But before that, they had the Ottoman Empire. They were ruled by the Persians. They were ruled by the Romans and stuff like that. It has led to a culture where they need rules. They need a strict set of rules where they know what's coming so they can expect what's coming. It makes them skeptical of democracy, which I found interesting to read. In 2010, they had an election, and when the president was elected, he was overthrown within a year, just because of the skepticism of his new ideas and stuff he brought back in. And then went kind of back to an old political class and re-elected another president when 22 of the 23 million people in the country voted for the old style ruler that they used to have before they elected the new guy that they overthrew. So it's very unique. And finally, it is a very feminine society. It doesn't really care about your achievements. It's more about what are you going to do to help us, what are you doing to show you care to make Egypt a better place. So the accounting system in Egypt. I chose Egypt because it is not made, it is one of the countries in the Middle East. Many of them are going to IFRS. Egypt is a country that has refused to make the change. For years and years and years, their accounting laws were limited, very small, and it was just for tax purposes. But in the mid-90s, they decided to make some changes to kind of try to converge with IFRS. And they did this a little bit before everybody else did. And even though they haven't adopted the standards, they've tried to converge. So in 1992, the Capital Market Authority is the law-setting body in Egypt. They created a law that created a stock market for the first time ever in 1992 for Egypt. And they established their first ever accounting standards that weren't just based outside of tax law. Before that, all the accounting standards were based on tax law. However, one major issue with that is that they did not require any annual disclosures in any of their companies at that time. So they put all these standards out and they told everybody how you need to account for stuff and what you should disclose, but then they didn't require anybody to disclose it. And they cited national security concerns for that. And that went all the way from 1992 until 2006, when the Ministry of Investment, which became another rule-setting body to deal with the stock market that was created by the Capital Market Authority, they adjusted the Egyptian accounting standards to become more like IFRS. So they made the disclosures, took away the national security concerns, made everybody start disclosing them manually, and they made some major changes to leased assets, the disclosures of the fixed assets, just to get fair value accounting and get things more up to date. However, at that time, they ignored the 2007 IFRS updates and have not updated it since 2006. So they're not keeping up with the new changes, but they are in the IFRS 2005 level. And what's interesting is that we can study, I like this country is because they went before everybody else. So we were able to get a study on how the implementation of these new standards actually affected disclosures. So Dahawi in 2007, in 2002, Dahawi wrote a paper about how secrecy culture could impact the implementation of these new standards and what it affects in 2006. And he basically said that it wasn't going to be very good for Egypt, was his conclusion in that paper, because of the secrecy culture. Well, in 2007, he went back and he studied after it has been implemented to see what was going on. And here's what he found. It's still largely based on the law of the land, and large parts of it allow for discretionary disclosure. Okay, so some examples of that. When he started digging into financial statements and looking at stuff, Even though rules such in the EAS and IFRS require manager bonuses to be counted as compensation expense under financial statements, we found them being reported as dividends. We found that people were required to consolidate, but yet the Egyptian government required unconsolidated statements for tax purposes. So therefore, people weren't consolidating for tax purposes, and then just decided it wasn't worth their time or their cost to make consolidated statements. As you can see in the implementation, only 45% of the companies that were required to consolidate were actually consolidating 2 years after this got into place. Only 61% of the companies showed compliance with the new rules, whether in regards to leases or expenses or anything like that. And a lot of times, people just would refuse to make these changes. An example of that is the insider trading rules that were put out by IFRS and adopted by the EAS. It goes against all the cultural norms of Egypt. To them, insider trading is nothing wrong with it because of the hierarchical structure. If you're in the same class as me and I know the information, there is nothing wrong with me telling you that information so you go make money on it. And just because IFRS or EAS tells me I can't do that anymore, I'm going to do it anyway. Because it's against our cultural norms. And at the very bottom, we see again enforcement and auditing. Enforcement and auditing always seems to be an issue whenever we get into secrecy cultures. Countries with these cultures, they're afraid to not only give out the information when they find something wrong, they don't want to tell them. Given that the firms and secrecy cultures are more likely, they have lower transparency and a higher risk, auditors are more likely to issue modified opinions to protect their valuable reputational capital. That is from Chin et al. Right there. And they did a study, and they studied the accounting practices of 17 micro-based countries. And they found that across all the firms, that audit companies were just rubber stamping. They weren't doing their due diligence. They were just going in, and these weren't the major big four companies. They're hiring smaller local firms. So if you're a Japan company, you're hiring a Japan accounting firm that's just there, and they're coming in and doing a Japan audit and rubber stamping it for you. They found that countries that have investor protections, so maybe you have some kind of enforcement agency that has a little bit of teeth to it, where they can actually get out and enforce the rules that are set out. They find there that there's less of a chance, but it is still happening. And much to everybody's surprise, they found that multinational corporations are not immune. So if you have a company, multinational company in the United States, and it may have a subsidiary coming back in Japan, and you're counting on the Japan auditors to audit those statements in Japan to send back to you for consolidation, just be wary, because that could just be a rubber stamp audit, because even though it's coming back under GAAP, it's not immune to these issues. So just some final thoughts for you as I leave you here tonight. Accounting languages vary greatly across the world. It's just as different as a spoken language. You can walk out and get into Mexico and Canada, you never know what you're going to find. Culture plays a tremendous impact. We just looked at one aspect. We looked at secrecy versus transparency culture. If you remember back, there was uniformity, statutory control, and conservatism. Some other things, they all play a major role. So it's all these things working together, combined with what the accounting principles are going to be. And even though we're moving forward into the next century, standards don't always translate into practice. Just because a country has adopted the standards doesn't mean that that's what you're going to see on your financial statements. Because audit statements may not always be accurate, as we just talked about. So be cautious. Use your due diligence when setting financial statements, and don't take everything at face value. Be aware that when you go into another country or another culture, what you see may not always be what you think you see, and don't be afraid to ask questions. Thank you very much.
Does anyone have questions? Go ahead, Mr.
want to stop the video before question, because they said that might, okay.
So my question was back on the culture theory part.
Yes.
When was the like the numbers, like when did they do that testing for that? That was already like everybody's rankings.
Okay.
Or when was the last time they?
Okay, so those are old numbers.
Okay.
They're from Hofstede Insights. So Garrett Hofstede, when he made, all those, he took the study of 300 IBM companies from all over, and those are what those numbers are based on. As far as I know, where they have it. Which is actually an issue because cultures are constantly changing, so these numbers could be a little bit off than what it is today. Culture is a very fluid issue, so it's something to be aware of. Yeah.
Why do you think the U.S. hasn't joined IFRS yet?
Why? Because of the litigious nature of our society, it being more principles based. We do need more rules here because of our Florida law. When it comes to certain things, IFRS doesn't guarantee the protections that US GAAP does.
Do you think that if we ever convert, that we'll make our own brand of IFRS?
I don't think there will ever be a worldwide accounting system. I don't think the United States will ever give up its autonomy in this part. And I don't really see a lot of countries giving up their autonomy when it comes to cultural issues. Because you talk about countries like we just mentioned, Japan and China. You see the cultures and the way they expect achievement, and the way they view themselves as masculine nature, the way they have the power distance, separate the rulers from everybody else. Do you think they're going to want to give up their own power and their own accounting principles to another authority? I don't see it. Yes.
I thought it was interesting you're saying that, like, Japan has recently tried to implement some transparent measures, as China was as well, if they're changing their standards, be more open. Do you think this was due to the fact that they have to do so much business with the Western world? Are they kind of forced to change their culture to adapt?
Yes. I wouldn't know. I wouldn't necessarily say they have to change their culture to adapt, but they have to change their business practices in order to be competitive in a global market, is what they're finding. Is that if they want to attract the top money from other parts of the world, whether it be the United States or Europe or Australia, these people expect certain things, and their financial systems, their accounting language wasn't providing what the investors needed.
So then do you think that business practices in general will become more consolidated in the future or similar?
I think yes. Business practices will become much more similar. And I think we're seeing that as he's saying, if we come up with I don't think we're ever going to have one set of standards, but what we're seeing is a lot of standards getting very, very similar, with just maybe little minor differences here and there. And I think that's going to be more the norm than anything else.
Okay, well, anybody else got questions? All right, well, thank you very much. I was just going to give some last minute comments about future events that we have coming up. Matter of fact, we'll save some.